Want to look at monetary policy for an economy in a liquidity trap. Since the economy is in a liquidity trap, that is, with an equilibrium nominal interest rate equal to zero, so we know the initial equilibrium of the economy would occur somewhere along the horizontal portion of the LM curve. So it would be where the IS curve intersects the horizontal portion of the LM curve, somewhere like a point A in the figure here, where we can see our initial equilibrium output is YA, and since the economy is in a liquidity trap, its equilibrium nominal interest rate is zero. Now, what if the central bank decides to increase the money supply? So, as a result of this, what's going to happen is there will be a parallel rightward shift of the positively sloped portion of the LM curve, and the horizontal one would become longer. So initially, our LM curve was given to us as OX LM1. Now it's given to us as OZ LM2, where we can see there's been a parallel rightward shift of our upward sloping of the portion of the LM curve, and the horizontal portion will become longer. Initially, the horizontal portion was OX, now it's OZ. So our new LM curve is OZ LM2, and we still have our unchanged IS curve. Now the new equilibrium will occur at the intersection of an unchanged IS curve and a new LM curve, OZ LM2. And what we see here, the intersection is still taking place at the initial equilibrium point A, so that will remain the equilibrium position for the economy. So what we're seeing is that in a liquidity trap, monetary policy is completely ineffective in increasing output. Despite the increase in money supply and the LM curve shifting, the equilibrium position of the economy remains unchanged. So it's completely ineffective in increasing output. Now, if we try to understand the economic intuition, the reason is because since we're in a liquidity trap, interest rate is already at its lower bound. Therefore, increasing the money supply is not going to cause any further decrease in the interest rate. So the monetary transmission mechanism will break down because if interest rate does not decrease, it won't cause investment to increase and hence aggregate demand and output to increase. Because the way monetary policy works is that money supply changes, that changes in interest rate, which changes investment, which changes demand, which changes output. But here, when money supply changes, because it's not changing interest rate, that link in the monetary transmission mechanism is broken down. And since interest rate does not fall, that does not stimulate investment demand and hence output. So monetary policy becomes completely ineffective in increasing output in the case of a liquidity trap.